All right. Thank you so much for joining me. I'm just changing over my audio here. Bear me 1 second. Just want to make sure that you get the best audio experience as well. Right. So thank you for joining me. We are going to shortly hear news as to whether or not the Monetary Policy Committee, who met yesterday, have okayed a Bank of England base rate reduction. This would potentially be the first reduction since 2020, so 4 years. And this will take us out of this 16-year high cycle where the interest rate for the Bank of England has been so high. We've never been at this level for 16 years. So we are expecting 65% chance that there will be some kind of rate cut today. However, it's not as simple as that. There are some spanners in the works potentially that will mean that they could potentially hold fire and not reduce interest rates today, put it off a further month until September, and wait to see what happens. Now, I'm going to go through with you what the main kind of concerns are. Now, I'm just going to share my screen actually, just so I can bring you into the key things that are kind of this catalyst for a bit of uncertainty around what will happen today. And then in about 9 minutes time, we'll dive into the actual decision itself with the Bank of England as it's announced online. Let me just make sure I got this to fill the screen. Right, so this is Reuters right here. Okay, and what I want to do here is, what they're saying actually is there's a 50% chance of a quarter point rate cut today. Now, I'm going to come down to this graph right here. So as you know, inflation, which is the cost of things going up around us, headline inflation has hit the 2% target. So that's where we are right now. This is CPI. This is headline inflation. However, there are concerns in this decision around service inflation, which is at 5.7%. So service inflation includes things like the cost of things and services that you would purchase, hotels being a key barometer in that. And ironically, they're blaming Taylor Swift for this because obviously she's just had a world tour. She had a stop here in the UK. And during that period of time, it was well publicized in the news that her concert alone was going to add £1 billion to GDP. And as a result of that, hotel prices have gone up. And that's the main concern around service inflation. It was hoped that we would see service inflation at 5.1%. But as you can see here, the number in June is 5.7. It's not good from the economics or the economist's point of view when they're looking at this equation of interest rates, inflation, have we got it under control? The other concern is wage growth. Wage growth is still at 5.7. And you might ask, well, how does wage growth impact inflation? Well, with wage growth, that means people spend more money. There's more money in circulation, which potentially pushes prices up. It's not as, and this will sound very, very strange, I know, it's not as conducive to this conversation about reducing interest rates at this point in time for inflation. Although there is the obvious and very good argument that we've not seen wage growth for a very, very long time. So it needed to happen. It needs to happen as long as it welcomed. To put a spanner in the works there, as we've already covered this week, one of the measures announced by Rachel Reeves was this 22.5% increase for doctors, junior doctors over the course of 2 years. So it's about 11% per year. That is also going to be factored in at some point. So when you look at a combination of these two things, the question is, are we in a place where the Bank of England is going to feel comfortable enough to reduce interest rates? Now, interestingly, the Fed, which is the Federal Reserve, so this is, if you think about the Bank of England being the body that controls monetary policy and decisions around interest rates here in the UK, the Fed is the American equivalent. They held on interest rate decisions yesterday. They are potentially going to be pushing this till September. And if you've been following this saga around interest rates and inflation, we've kind of been in lockstep to a certain degree with the States, where we've kind of mirrored their actions. So will we do the same today? I'm not sure. I think there are a lot of people who are saying and hoping that we're going to see a rate cut. I'll come on to a little bit of that a bit later on. I've just covered the concerns. After we've got the news through, and actually, let me just talk about this right now. Let's make no mistake with this. We need, from an economic point of view, and I guess from a individual person's point of view, we need this today. We need positive news around the fact that the Bank of England does cut interest rates from 5.25 to 5%. Nonetheless, because of the fact that we have, and I've got the number here, 560,000 UK households who will be remortgaging before the end of the year. And with that 560,000 households who will be remortgaging, a lot of them will be coming off mortgage rates of 1 or 2%. And with the current rate of interest at the moment, mortgages are a 2-year fixed rate. It's still plus 5% plus, 5% more, roughly 5% plus. So if you're going from a 2% fixed rate into a 5%, it's going to be a big, big impact to your monthly mortgage payment. Statistics have told us throughout this year, pretty much in the run up to this, that the average household in the UK is probably going to see about £500 a month extra on their remortgage. So there are over 500,000 households that need this today. Now, if they do cut the bank rate from 5.25 to 5% today, then per month is going to save the average house that is going to go from a 2% into a higher rate, about £30 a month to £360 a year. Unfortunately, you're still going to see a jump, but if the reduction in the base rate happens today, it won't be as much as it could have been if they did nothing. So I think all eyes are going to be on their decision in about 3 minutes' time, depending on what they decide to do today. But for mortgage holders, this is going to be something that I think will be very much welcomed in terms of we really, really need this. Then we get on to savers as well. What's going to happen with savers? I mean, interest rates will go down for savings accounts. And if you haven't already watched the video that I posted on Tuesday, it's definitely worthwhile going to watch on Tuesday, because the Bank of England base rate is essentially there to dictate what the savings rates that are offered on the high street are and what the borrowing rates on the high street are. I mean, we need this from an economic point of view as well. At this point in time, with the bank rate so high, it means that businesses have a higher cost of borrowing. So therefore, they may be hesitant to invest in their business, and we need this in order to grow the economy. So any reduction in the base rate today will mean that it will be more attractive for businesses to borrow money, to invest, and potentially that leads to the argument of economic growth. And by God, do we need that right now, especially with some of the projects that were scrapped in the announcement this week by Rachel Reeves. So we really, really, really need this right now. So I'm just keeping an eye in the background of the news from Sky. I'll chuck in a live feed once we know what this is. But I'd love to know in the comments, what do you think is going to happen? Do you think they're going to hold rates? Let me just come full screen. Do you think they're going to hold rates, or do you think that they are going to cut rates? What's your general thought? I asked this on Instagram a couple of days ago. I'm just going to see if I can just look at the results of the poll here. So on Instagram, 72% of people thought that they would keep the bank rate the same. 28% thought that there will be a rate cut. I'm interested to know what you feel watching this right now. Let me see if I can actually start a poll just to get a really good, accurate read of what you guys are feeling. Let's, what do you think? If I can type. Okay, so I'm going to say rate cut. That's option 1, or stay the same. The same with an M, not an N. All right, cool. The poll's out right there. Let me know what you think. What do you think is going to happen? They're going to hold? They're going to cut? What do you think? There were a lot of economists saying that they think they might hold. purely because of service inflation, wage growth. They'd like to see that come down a little bit before the decision comes across. Who knows? Who knows? All right. So let me just pop in this feed from Sky, and let's just hear what's going on right now. What am I doing? Share. We want this one. There we go.
I'm just looking to see if I can get details on the vote here from the Monetary Policy Committee. It was 7-2 last time around in favour of keeping interest rates on hold at 5.25%. Bear with me, Gareth.
There we go.
As soon as I get the Monetary Policy Committee update out, I will tell you it was a 5-4 vote. So in other words, I would suspect on that basis that the Bank of England Governor Andrew Bailey has had the casting vote. 4 members of the Monetary Policy Committee voting to retain interest rates at 5.25%. Obviously, a lot of concerns here. I'm just looking at the minutes of the meeting now. The bank has also updated its projections for inflation because obviously we get the monetary policy report today as well. The bank observing here, the MPC observing, obviously, as I said to you earlier, headline consumer price inflation at 2% in both May and June, back to the bank's target rate. The minutes note here, earnings growth fell to 5.6% in the 3 months to May. Services inflation coming down. So the bank obviously satisfied there that inflationary pressures are starting to ease. In terms of the immediate policy decision, it looks as though the committee was briefed in advance on it was briefed on the July statement. That was the pay rises I referred to earlier from Rachel Reeves. It looks as though the bank has also taken into account sterling here, the fact that the pound has risen. The voting breakdown here then. Andrew Bailey, the governor, of course, as I say, he had the casting vote. He voted to reduce interest rates. Along with him, Sarah Breeden, another internal member of the bank, Swati Dhingra, she's been the perennial dove on the Monetary Policy Committee. She's been voting for rate cuts for quite some time. Also voting for rate cut, Dave Ramsden. Again, he's been voting for cuts in the last few meetings. And Claire Lombardelli, she's the newest member of the Monetary Policy Committee. This was the first time, in fact, that she voted. She has voted to cut interest rates as well. Voting against Megan Green, Jonathan Haskell. This is his last meeting at the MPC. Catherine Mann, who's often regarded as the most hawkish member of the committee, and Hugh Pill, the bank's chief economist. Looking at the meeting here, the reason that the Monetary Policy Committee has given these 5 members who voted for reduction, they say they feel it's appropriate to reduce slightly the degree of policy restrictiveness. The past impact of past external shocks has abated, and there's been some progress in moderating risks of persistence in inflation. There'd been a normalization in inflation expectations, which is something that the bank looks at very, very closely, and forward-looking indicators such as surveys on pointing to waning wage and price pressures. That goes on to say the recent strength in services inflation continues to reflect more volatile parts of this series. Although GDP growth has been stronger than the Monetary Policy Committee had expected, they think that interest rates, according to these 5 members, have started to weigh on activity in the real economy, leading to looser labour market. Obviously, we've seen that slight pickup to unemployment to 4.4% in recent months. And it goes on to say here, though, Gareth, in the minutes, for these members, the decision was finally balanced. Inflationary persistence had not yet conclusively dissipated, and there remain some upside risks to the outlook. I think what you can take from that is that this might be the last interest rate cut for a while. I mean, the market is, as I say, pricing in another rate cut between now and the end of the year. But it looks like this decision was pretty finely balanced, as we've seen from that 5-4 breakdown.
Right, this is really, really interesting what they've actually said here, which leads me on to what happens next. This is good news. I think we've already said here 560,000 households will be on a mortgage right now who are coming out of their fixed rate terms, with the prospect that they'll be going on to significantly higher rates. I mean, you're still going to go on to a higher rate, but not as high as if they kept it at 5.25%. So over the next day or two, it's going to be very, very interesting to see how this translates to the mortgage market specifically and the rates on the mortgage market. In terms of savers, we're going to pretty much see an instantaneous reduction in a lot of the savings accounts that are available out there. And again, if you've not watched the video on Tuesday, that will be worthwhile watching because it was made in anticipation that this would happen today. And I talk about how interest rates work, how it controls borrowing and savings cost, and the various types of accounts that you can have a look at to ensure that you're able to snag yourself the best rate at any given time. So if you've not watched it, I would really strongly encourage you to go watch it. Other thoughts here. Now, interestingly, are they likely to put on hold additional rate cuts this year for the reasons that he spoke about a second ago? If you look at the forecast and what has been foreshadowed through most of this year, it has always been earmarked 2 bank rate cuts. This is the first one. This is finely poised and has been finely poised 5 to 4. So there's not a significant majority that have kind of given the indication that they really believe that we're out of the woods. And so they might hold off on an interest rate cut later on this year. It's going to really depend on what happens between now and monitoring service level inflation and wage growth. Those are going to be the core factors that they're going to be having a look at in that decision. I wonder, and let me just see if I can get this online right now, because if you have been following me for a while, we have been tracking what the forecasts have been since the beginning of the year, and even through last year as well, in terms of what the interest rate forecasts are. And if you recall, we were looking at it, I think it was last month or so, and inflation was set to increase through the back end of this year. So let me just share this screen with you, just to get a sight of the new forecast for interest rates and what we think they're going to be. Okay, so this is Trading Economics, and they pulled data from office departments to give us an idea of what inflation and interest rates are going to be. So this hasn't really changed that much. Bearing in mind the information has only just come out, so it'll probably come out over the next couple of days or so and update in this fashion. But I think it's worthwhile having a look at what the snapshot was. So Q3 this year, inflation was forecasted or expected to increase to 2.2. Then in Q4, up again 2.4. Now, I don't know whether or not that will include this speculation that energy prices are going to increase, because energy prices this winter are supposed to increase. In fact, I've been involved in a campaign with to kind of bring awareness around what to do if you are going to be struggling this winter to pay your energy bills. And I think the winter fuel payments being cut for 10 million pensions, that campaign is going to be even more important. It's not live just yet. It's going to be live later on, I think it's September, October. But in Q1 and Q2, we start to see inflation come below the 2% target. And as you can see here, effectively interest rates mirror that. So this is Q3 currently that we're in. Well, we're about to enter. Have we entered Q3 right now? Where are we? We're in August right now. Yeah, so near enough. 5%, so that's on target. Will we see a 4.75% cut in Q4? That's what they've been questioning, because the fact that this has been so finely poised at a 5 to 4 vote to bring the interest rate down to 5% today. In Q1, it was supposed to be at 5.5%, Q2, 4%. I often get asked, what do I think interest rates are going to land at a year from now? And I think from all of the materials that I've been speaking to and the people that I speak to who are still in industry, the consensus is 4% roughly is where we're going to see interest rates sit at over the next year or so once all the dust has settled. I want to just reiterate, we're not going to get back to that period of time where we had 1-2% interest rates on mortgages. Those things are just long gone now. So we need to make an adjustment. And that's what I've been talking about for a very, very long time now on this channel. Financially, because mortgages will go up as a result of mortgages and the cost of borrowing going up, rents are going to go up. And we've already seen that for a lot of rentals already. The cost of living isn't going to dissipate. So the cost of things have increased. They're not going back down to where they were. That's the function of inflation. Because prices go up doesn't mean that once inflation has subsided that the prices go back to their previous levels. No, that's not how it works. So we need to be really, really mindful of that and be aware of that. And what that means is that from a personal finance point of view, it is about understanding financial management, having a financial plan. If you don't know how to build a financial plan, might be looking to purchase a home or save for kids' university fees, there is a link that you'll find in this video to a one-page financial plan. It includes a 10-minute tutorial on how to actually use it as well. Go check it out. Let me just jump into the comments really quickly, because I do have to leave in about 5 minutes time, because I've got to head to London, because I'm going to be doing Channel 5 news later on this evening. Okay, so let's have a look and see. Leandro saying nice polo. Thank you very, very much. I don't know if Gomic or Gnome agrees with you here. Are you working on the bins now? Don't know what you mean, mate. Let's just move on from that. Ferbix is saying here, Fed's held, so we will as well. I think that was kind of the consensus that we might hold in conjunction with the Feds, but who knows? Adam is saying here that my current mortgage rate is 4.2 with an increase at the current rate. How much should that increase my mortgage by, due to renew in January after a 2-year fix? You'd have to do a calculation. There are lots of calculators you can use online, mate. I think if you go on to moneysupermarket.com, they do have a mortgage repayment calculator that you can use, so you can anticipate what that increase is going to be. And Adam and Visual's also just saying here, it also depends on the term of your mortgage and your mortgage balance as well, and your loan to value. So your loan to value will have a massive impact on how much or what rates you're going to get offered. Obviously, you have a high loan to value, then for the bank, they'll deem that as being higher risk. So they'll charge you more. If you have a lower loan to value, it's less risk for them. So they charge you a little bit less. What is Doc Red saying here? Need to go down by another 2%. Probably, but mate, I don't think that's going to happen for at least another 2 years or so. I think we'll see a gradual reduction in the bank rate from now on. It won't be anything that happens drastically within a quick period of time, because they wouldn't want to undo any of the work that they've already done. Someone's just saying here, be on a mortgage tracker at the moment. Will my next payment be adjusted automatically? It should be adjusted pro rata. So depending on how it gets translated, yeah, you'll have a pro rata calculation automatically adjusted to your monthly payments. Interest rates will drop to zero within the next 20 months. We will drop to pre-pandemic levels. Mate, you wish. That is not going to happen. I'll happily bet my house on that as well. Leandro saying, pay around for public sector coming up in August. I can't see Bank of England reducing interest rates this year. I think it was already kind of mentioned in there that they would have been told at the Bank of England that Rachel Reeves was offering, or had offered, that 22.5% pay rise to junior doctors. So that has been factored into this decision, essentially. So it's going to be interesting to see how this translates to the mortgage market. Once I know a little bit more, I'll make a few more videos just to kind of explain that a little bit more as well. More interestingly, we're kind of getting an inkling of the kind of tax increases that may be coming. The autumn budget is going to be in October. So between now and then, I think there's going to be a lot of speculation. I will do a video on the list of taxes that are already being spoken about. We've already talked about inheritance tax on one of the videos from last week, or was it this week? Last week. But as I know more, I'll share more with you. Thank you so much for watching. If you have any questions, please pop them in the comments. I will get round to kind of, answering them as I can. It will probably be tomorrow now, because I'll be traveling for the rest of the afternoon. If you've not already subscribed, please consider subscribing. And if you did get value from this, please smash the like button. It helps to make sure that other people who may gain some insights from this will also get to see this video, because the YouTube algorithm actually pushes it, because they take your like as an indication that you actually got value from the video. So thank you so much. I'll catch you soon. Cheers.